Now, let's review the CanSlim investment system. We want to buy the best stocks out there. How do you find the very best? CanSlim. Here's an interesting chart where we incorporate fundamentals, technicals, and the market. Fundamentals, we're looking at sales, earning, profitability, etc. Technicals, we look at charts. What's the chart pattern look like? What's it telling us? Charts also are very important for timing, price, and volume. Many believe volume is the heartbeat of a stock. And of course, we want to go long in an uptrend. We don't want to fight the trend. So CanSlim, the C, current earnings. We want a minimum of 2 quarters up, 25% or more. The model book stocks in our studies, they actually average 70% in the latest quarter at their breakout point. Quarterly earnings acceleration. The earnings are good and they're getting better. 25%, 40%, 60%, they're accelerating. We never want to buy earnings that are down and hope that they'll get better. Some work, but most won't. Quarterly sales up 25% or more. Quarterly sales acceleration, again, it's good and getting better. And of course, margins that are increasing quarter after quarter. A, annual earnings. Annual growth rate of at least 25% over the past 3 to 5 years. Also, we'd like a floor on the ROE of at least 17%. 2/3 of this whole problem we're trying to solve as investors is fundamental in nature. It's fundamental. We need to work with an outstanding company. A company with outstanding sales, outstanding earnings, outstanding management that is gaining market share, etc. N, new. New products, new services, new management, new industry conditions. CanSlim stocks tend to be the newer companies. They are not the older companies with old product lines. We found through our research that only 12% of previous leaders became leaders again in a future cycle. We also found that 80% of the leaders, they came public within the last 8 years. We're looking for new price highs off of sound bases. You see, the best stocks will be near their highs, not their lows, because they're under demand. S, supply and demand. Volume percent change in IBD is your best gauge of institutional demand. We put volume on a percentage basis. That way the institutions cannot hide their activity from us. L, leader or laggard. We want top stocks both fundamentally and technically in the best performing industry groups. We want the number one in their field based on earnings, not brand awareness. The best stocks over the last 50 years averaged a relative strength of 87 prior to their move. A question we get a lot is, well, if my stock has a relative strength of 87, doesn't that mean that the move is over? It's a logical question, but no, because the leaders, they're already outperforming the market before their move. In other words, buy high to go higher. And look for stocks with a relative strength and an EPS rating of 80 or higher. We found in our studies that the very, very best stocks have an EPS rating of 90 and a relative strength of 95. This is the elite group that we're trying to find. I, institutional sponsorship. The institutions are the driving force behind the market, whether we like it or not. Approximately 75% of the volume comes from the institutions. They are so large, they have the ability to buy and continue buying. This kind of activity is not from the public, it's not the day traders, and it's not Aunt Betty down the street. Let's look at how large institutional buyers operate. Here's the scenario. You're the fund manager of a $5 billion portfolio. You find an interesting idea, and it happens to be $40 a share. You like it, and so you want to establish a 2% position of that stock in your fund. Well, that equals $100 million or 2.5 million shares to get that 2% position. The average daily volume on this stock is 2 million shares per day. We know that if you buy approximately 5% of the average daily volume of a stock, you probably will not adversely affect its price. Therefore, you can buy approximately 100,000 shares per day. Simple math, it's about 25 trading days to do that position, but you have a problem. You can't have your trader buying 25 days straight. They will run the price of the stock through the roof. So what you do as the portfolio manager, you say to your trader, I like this idea. I want to get 2.5 million shares, and I'm willing to pay between $38.50 and say $41.50. And he or she gets to work, and they start buying within that zone, and gradually the price will come up, and so then they have to back off. And then they wait for the price to settle down, theoretically, and then they will step back in and they will make more purchases. They can do this on again, off again, purchasing for 2 to 3 months just to establish this 2% position. But you have another problem. You're only one fund. And how many mutual funds are out there and how many hedge funds are out there? And they're all looking for quality stocks and you found one and everyone else wants it? This is where you get these giant run-ups because everyone is piling in, and then the eventual collapse is because everyone's running for the door at the same time. Fund ownership increasing quarter after quarter. We want to see the sponsorship also increasing quarter by quarter, like the current earnings and sales. M, market. Are we in an uptrend or are we in a downtrend? We don't want to fight the trend. We want to go along with it. Are we entering the market on a follow-through day? A follow-through day typically occurs on the 4th through the 7th day or beyond of a new rally, and one of the major indexes is up 2% approximately with an increase in volume. And are we watching for a clustering of distribution days on the major indexes? Now, your rule here is that 4 to 5 distribution days on a major index in a 2 to 4 week period is usually enough to turn the trend downwards. The best way to stay on top of the market is to read the big picture and the market pulse columns every day in Investors Business Daily or on investors.com. That concludes CanSlim. Now, let's look at market tops and bottoms with Ken Shreve.